Hello, my name's Jeff Evans. I'm just going through a couple of questions that my students will need to do in their forthcoming exam, but also it gives me an opportunity to demonstrate how to use the iPad pen for this particular question. I think it's really good, so I'm going to take you through it and see what you think. So the students basically have to do an exam paper in May. This was last year's students' exam paper, and there's a couple of questions I'm going to take them through today, just so they've got a good understanding. And one of them is question 3, which is about impairment of assets. So I'm going to remind them of a couple of terms we've talked about in the past. One of them being the carrying amount, the fair value, cost of disposal, and value in use. The other term that I'll remind them of is what we call the recoverable amount, and that's something that we're going to have a look at through this particular question. I'll just get rid of that bit of pen from before. So in essence, it said the directors of Dorchester Limited are concerned that one of its machines might have become impaired. The following information applies. So it says we've got a carrying amount. We've got a carrying amount of 19,600, a fair value of 18,500, cost of disposal is £300, and the value in use is 18,400. So I say we're going to go through impairment of assets, IAS 36. So just let me explain. So in essence, we've got this asset sat in our statement of financial position, and it's valued at 19,600. Okay, but we know that's not what it's worth, because there could be something wrong with it. So what we do is we need to identify what we call the recoverable amount. Recoverable amount. Okay. And that equals, it's the higher of what we call the value in use or the fair value minus cost of disposal. So first of all, let's just define a couple of terms. So the value in use is basically, it says 18,400, is defined as being the value of the asset related to the cash flows generated by it. I'll say that again. So it's the net present value of the cash flows generated by the asset it's currently being used by the owner. So in other words, what the value of it is for the cash flows that it generates. The other terminology is what we call the fair value. So the fair value in this example is 18,500, and that's defined as the price that the seller would receive in what they call an orderly transaction between market participants. So in other words, it's what is the value that it would sell for in the normal marketplace. Okay, so we need to determine what the recoverable amount is and then take it away from the carrying amount. So I'll use different colour for this one. So we've got value in use, as it says, which is 18,400. And the fair value is 18,500 minus the cost of disposal, so the selling cost to get rid of it, which therefore gives us 18,200. Okay, so you can see the one that's the highest amount is the value in use. So that's the figure that we'll use to work out how much loss there has been in relation to this particular asset. So we've got the carrying amount. So the carrying amount, which is 19,600, as it sits in the statement of financial position, as we said. But then we've got the recoverable amount. So the recoverable amount, which was the higher of, which is the value in use. So 18,400. So we take that from the carrying amount, which therefore means we've got, so 1,200 is the loss on that particular asset. So record the asset in the statement of financial position of 18,400, and the loss on disposal is 1,200. Okay, hope that explains it. And again, as I said before, what I'll do for the students is send them a question with this video, just to give them an understanding of how to calculate it properly. Okay, so the next thing I want to move on to is the next question, which is to do with inventory. It's a bit further down. Yeah, so inventory IAS 2, and we've done this one on a number of occasions, so the student should have a good understanding of how to do it. So just to explain, it said that Petrizac, a veterinary practice, has made the following purchase of medical supplies in May 2017. It says that the opening stock of May, so there was no stock on the 1st of May, but on the 8th of May they've bought 200 units at £5 each. So it's really important to do the table. So on the 18th of May, you've got 200 units times 5 equals £1,000. So £1,000. And then on the 13th of May, you bought another 400 units times £5.60, which is £2,240. Okay. So in total, by the 13th of May, close of play, if you like, we've got 600 units that cost us £3,240. And it asks us to determine what the closing value of the inventories at the 31st of May using FIFO and weighted average. FIFO is first in, first out, so we tend to use it on things like sandwiches or perishable goods, so the stock that comes in first is the stock that goes out first. Weighted average, I always tend to say things like maybe if you've got a petrol station and you've got prices of petrol coming in at different times, and this stock valuation at the end of the year, as I tend to say to students, goes as your cost of sales in your income statement, but also your closing stock figure in your statement of financial position. So how you value it is really, really important. So I'll take you through both of the processes. So the first one is what we call FIFO. So first in, first out. Okay, so it tells us on the 20th of May that we sold 300 units at £8. The £8 is irrelevant for this moment, for this particular question, because we're more interested in the cost. So we've got 300 units that are being sold, and first in, first out, the stock that came in first was that one on the 8th of May. So we're going to use all of that. So 200 times 5 equals 1,000. We still need another 100 units, so they've all gone now. But we still need another 100, so we'll go for the stock that came in next, which was on the 13th of May. But we only need 100 of those, so 100 of those, and they cost £5.60. Yeah. So therefore, that's £560. So the total cost of the issue using FIFO was £1,560. So that's the cost of the issue, yeah? And then we've got the closing stock figure, or the closing value, so closing stock. So we bought £3,240 of the stock, but using FIFO we've issued out 1,560. So therefore it gives us a closing stock figure of 1,680. Okay, so bearing in mind this is stock going in, these two figures, that's stock going in, and the 300 is stock going out. So that's FIFO. The other one, which I'll show you, we don't do this one anymore as such because it doesn't follow what we call the prudence concept, which is LIFO, which is last in, first out. So I'll just show the same principle. So this time it's 300 again, but this time we can take it, so the stock that came in last was that on the 13th of May, And we can take all of that from, because we've got 400 of them, so we'll do 300 times £5.60. I'll just use my calculator for this one. Should have it set up. So £300, so 300 units times £5.60 equals, so 300 times £5.60 is 1,680. It's interesting, isn't it? So 1,680. That's the cost of the issue. See? Just better check that. So 300 units times £5.60 is £1,680, yeah? So that's the cost of the issue, and the closing value or the closing stock figure using LIFO would be, so it costs us 3,240. The cost of the issue was 1,680. So therefore the closing stock figure using LIFO would be 1,560. But again, as I said before, we don't use LIFO anymore really, because it doesn't follow the prudence concept, which basically means, so the stock that came in last is the stock that goes out first, okay? So it tends to leave you with the oldest, with the oldest stock, which isn't really a true reflection of the market value. So we don't tend to use that one. And then finally, the AVCO, or the weighted average one, which is, I'll change the colour for this one. So this one was same for like petrol. So for AVCO, or weighted average, we go 3,240, which was the cost of the stock, and we bought 600 of them. So therefore that gives us an average figure, so 3,240 divided by 600 so 3,240 divided by 600 is £5.40. So the average cost was £5.40. So we multiply the £5.40 by the 300 units. So times 300 equals 1620. So the cost of the issue is 1620. Same process as we did before. So the closing stock figure, so the amount of stock we bought was 3,240 minus the 1620 gives us a stock figure of 1620. Point being, 1620 for AVCO, 1680 for Fifo, and 1560 for LIFO. So you can see the different closing stock figures doing the method that you've chosen. Anyway, that's all we need to do for this particular part of the assessment. And again, as I said before, I'll send out these very similar questions for the students so they get a good understanding of how to do it. And secondly, I hope you like the use of the iPad and its pen.